I think if you had asked Ken and I 10 years ago if we would be sitting up here saying things like utilities are cool and sexy, we would have thought you were crazy, and yet here we are.
Here we are.
Frankly, hedge funds, another area that is getting more and more exciting and interesting.
Now you're talking.
The 60-40, I know Winfield loves talking hedge
Don't
funds.
get started.
This is going to shock Ken that I'm going to say this.
I think I know what you're going to say this, but one word, optimistic or cautious?
I heard that that's going to be pretty darn good.
Okay, well, he just broke a little news. You're going to get in trouble for that later. We are 6 months into the year, and our outlook from January is proving to be largely intact. I wanted to go straight to the source to hear what we think the second half of 2026 holds. I'm joined by Global Co-Chief Investment Officer Ken Caplan and Winfield Sickles, a Managing Director on our investment strategy team. Hey, guys.
Hello.
Great to be with you.
Thank you for doing this. We appreciate it. We're excited. All right, so before, Ken, we get to the good stuff and dive into the report, I would love to hear a little bit about how we get to these insights. So there's obviously this massive data machine that you sit atop of that tells us what's happening across our portfolio. How do we do it?
So it is a lot of fun and a thing that I think Winfield and I both get very excited with our teams, having this access to this data and being able to use it. And we start by really assessing the landscape, right? What's changed, what's held, what's the data telling us, right? We are the largest alternatives asset manager. As part of that, we have 280 portfolio companies, right? That's a benefit of having the largest private equity business in the world. We have around 13,000 real estate properties. Again, a benefit of having the largest commercial real estate portfolio in the world. We have 5,000 plus issuers, credit issuers in our credit business. And when you pull all that together, it gives us a lot of data, right? If you look at just the portfolio companies, over 700,000 employees in the portfolio companies, that tells you something about the labor market, about wages, about hiring. So we look at all that data, that allows us to spot patterns, build conviction, and then invest. So we bring that all together. We then talk to the business unit heads. We then talk to our CEOs, the senior management teams in these 280 portfolio companies. We actually formally survey them once a quarter about more than what's happening in the data. What are they seeing in the environment for their business? Get some more qualitative information as well. And then we bring all that together and we distill that ocean of data and see what the strongest signals are. And then we use that to start developing, our strategies, our themes, and where do we have more conviction? Where do we want to be leaning in more heavily? Where do we maybe want to be leaning away from? And we use it, internally in meetings and in dashboards and in these signals that we try to use for investing. And then we, increasingly are putting them out in pages and papers externally like we did in this investment perspectives piece.
Which is really recent. I mean, we used to do this and just use this for ourselves, right? To develop themes and figure out how to invest, but and
we're trying to get it out there more.
I know. Okay, so then dive into 2026.
Yep.
I'm curious to hear from you how the first half has played out, and from when we issued our January report, what's tracked your expectations? What surprised you? Give us a little.
The end of last year, beginning of this year, we put together a 2026 investment perspectives piece that we published in January. And so when we revisited that, despite everything that's been thrown at the economy, despite all the change, despite the geopolitics and everything else, it really held. And the biggest thing that we had at the top of the page with the same words, artificial intelligence, the main thing, it's gotten to be somehow even a bigger main thing. This demand that we're seeing for AI, this multi-year CapEx spend, this significant CapEx spend that is having a big impact and creating a lot of opportunity, that we view as top of the list. And that you'll see where we're investing across the firm, debt and equity, big opportunities. A lot of disruption, a lot of areas to be focused on, but also a lot of opportunity there. Growth still very resilient, particularly here in the U.S., but uneven, right? We're not seeing everything move at the same speed. I think Winfield's going to talk more about that. Labor market, I mentioned we have these 700,000 plus employees, and we're seeing a healthy job market. Right? We're seeing a healthy job market here in the U.S. in terms of hiring, with wage growth staying under control, so that's a good place to be. Inflation, yes, we saw an uptick in the most recent CPI number. That was, biggest driver of that was oil and energy, and that's fortunately come back down quite a bit. We do have inflation coming from all this AI CapEx spend, if you're in the path of that, and we see this, in some pricing and products like Apple mentioned in their recent pricing. But outside of that, and when we look more medium and longer term, we feel much better about a cooling inflation because of the wage growth, because of shelter costs, frankly, because also productivity gains that we'd expect to see over time. And then finally, capital markets are healthy. We'll talk more about this, but the debt markets, the equity markets, IPO, M&A activity all feels good. So that's actually quite a positive backdrop, despite the headlines that you might be reading about every day, where, yes, there is a lot of uncertainty, but there is a lot of resilience and strength underneath that. And I think you don't want to miss that by seeing only the headlines.
Amazing. Well, so and you, Winfield, spend a tremendous amount of time on the road with our clients, sort of helping synthesize all of this data for them and hearing what's on their minds. I'd be curious to hear what you're seeing in the data, what it's telling you about the economy.
Absolutely, and it's great to be with you guys. And just to put some meat on the bones that Ken laid out, on the growth side, when we look at our portfolio companies, both on the revenue side and the earnings side, it looks really constructive. Now, there is regional dispersion. You sort of alluded to it, right? The U.S. and Asia are growing in the double digits. Europe is lagging behind a bit in the lower single digits. But when you put it together, it paints a positive picture. To get away from the regions and sort of focus on the sectors, I would say the breadth there is pretty solid. But if you made Ken and I pick out one sector, we would probably double click on energy. Right. If you look at our companies that are benefiting from electrification, reindustrialization, data centers, et cetera, they're the ones that are sort of leading the pack. On the labor market side, and again, piggybacking on what Ken said, in the US, it is a very, very positive trajectory that we're on now. If we zoom out and we go sort of post-COVID and we take headcount growth, right, year over year, we look at it every quarter, Ken and I and the team sort of obsess over this, what you would have seen would have been kind of a steady 2 to 3% headcount growth if you smooth the numbers out. I think we think of that as low hire, not no hire. So it wasn't great, but it wasn't bad either. What we've seen recently, and we talk about it in the piece, are some green shoots where that number is going to something more like 5%. What's driving that? There's some stuff on the white collar side. Who knew that we needed more software engineers with AI? But a lot of it is on the blue collar side, this blue collar jobs renaissance. And then on inflation, again, Ken touched on this, near term, incredibly noisy. I'll throw tariffs in the mix like the tariffs, energy, AI, CapEx, because listen, when you have a CapEx boom like we're having, and Korea and Taiwan are the big producers of memory and DRAM and NAND, that's adding to that confusion. But medium term, tariffs are falling away. And then wages, if you looked at wages in our portfolio companies going back 2 years, 5%, 4% a year ago, now they've stabilized at 3%, that's great. And then shelter. I mean, shelter is basically half of core CPI. Yep. Government data lags by about a year, so we've long taken our real-time tenant data, imputed it, come up with our own number. And so if you look at the government's 2.9% number, our internal number is 2%. And then the last thing, I'll land the plane here, and Ken mentioned it, is productivity, right? If you look at productivity just in the last 3 years, it's trending almost double the prior 15 years. And that's before about 95% of work tasks have been touched by AI. Supply side driven AI productivity revolution, it's highly deflationary. So near term noisy, but medium to long term, we're more constructive.
That productivity engine's really going to kick in.
Absolutely.
And all those are reasons why, again, you got to look through these headlines, right? This 4.2% headline CPI number, biggest driver of that was energy. If you look at a core number that it takes out food and energy, drops to 2.9. We know that they measure shelter on a lagged way. If we put a real-time shelter, it comes down to 2. So that's an example of just looking at the data and what the driver is and looking kind of a couple steps beyond that.
Right. Yep. Okay, well, you mentioned power. We're going to talk about that in a second, but AI is a megatrend.
Yes.
So
AI is a big
surprise, we're not the only ones talking about it, but I'd love to get your take a little bit on where we're at, where you see this going.
Right. Well, it is a bit of AI all the time in the paper.
You got to get away from almost the buzz to actually
There's a lot of buzz, there's a lot of ambition, and a lot of excitement, and I think it's appropriate excitement. I mean, we're all using AI more and more. We're seeing it in our businesses, right here at Blackstone and in the portfolio companies. It's quite powerful, and it feels like it's still early, and there's much, much more to come, right? We're seeing this technology, which is having faster adoption than any technology in human history. And that demand is just extraordinary. And the supply is just not able to keep up with the demand. And as a result, you're seeing this scramble to build more infrastructure and supply to meet that demand. And we've been early on this, which has put us in a really a great position. We bought a company called QTS between 2021 and 2022. That was about 5 years ago now. We bought a company that was a publicly traded data center company that we liked because we saw content creation and social media and early stages of AI and all contributing to more and more data needs and more data center needs. That next symbol is ChatGPT, and you can see after ChatGPT came out, a lot of data center construction. And despite all that construction, there's still less than 1% vacancy because, again, the supply just can't keep up with the demand. And to give a sense of the scale of how much money is being spent, you have 5 companies, these 5 large hyperscalers, that are going to spend nearly $800 billion just this year alone on their CapEx build-out. And that's going to be over $1 trillion estimated next year and continue to grow over the next 5 years. And that infrastructure, really 3 main pillars. It's data center, it's all data. So it's data centers, the chips, and the power. And all those are hard to deliver. You need a lot of capital, you need a lot of expertise, you need to get the equipment, for data center, you need the land and the permitting. Just on the people side at QTS, by the way, QTS, we've grown 15 times in the last 5 years. I mean, that's extraordinary. And when you see that, it tells you something's happening here that you want to be ahead of. But in QTS, a little over a year ago, we had, I think, 13,000 people on site on construction. By the end of this year, expected that to be 40,000 people. I mean, so these are not easy to do and to build. If you can be that solution provider, debt or equity or anywhere, and provide that supply, that's a good place to be. And it's a very large-scale opportunity. This is, to me, like the most exciting area of investment that I've seen, and why we've been leaning into it.
Yeah. You've heard us talk a lot about picks and shovels over
a lot of picks
and shovels, but it makes sense.
Yeah.
So a very big adjacent theme, obviously, mega theme is energy, right? These two things, as Ken was just talking about, go hand in hand. So curious to hear what you're seeing there and where investors should be focused on.
Absolutely. I love to talk about
I know you do. We're keeping
power.
it tight, Winfield.
Hedge fund guy, used to trade, invest in commodities, including power. So this one is near and dear to me. Don't worry, I'm going to keep it very stay I do like to always frame power.
We like to talk about this stuff.
Yeah.
Right.
Go to lunch afterwards. We got to stay on time.
Yeah.
I always like to frame around this interview that our president and COO John Gray did 6 to 12 months ago, where he was asked in an interview, they said, what's the one thing that Blackstone is sure about, 100% sure? And he said power. He said, we cannot model as a firm 5, 10, 15, 20 years out an environment where we don't need more power. And when you juxtapose that on 30 years, not just in the US, but in Europe as well, of electricity demand essentially flatlining. And then now all of a sudden, because of economic growth, reindustrialization, electrification, data centers as well, we're going from that flat line to something like 40 or 50% over the next 10 years. And then you look at the grids in the US and Europe and 40, 50 years old, decades of de minimis investment. And so for us, for Ken and myself and the teams that we work with, generation, transmission, distribution, ancillary industries, I mean, it's such a fat pitch. And, I smile about this when I think about it, because I think if you had asked Ken and I 10 years ago if we would be sitting up here saying things like utilities are cool and sexy, we would have thought you were crazy, and yet here we are.
Here we are.
And what Winfield said is actually quite important. It's this whole ecosystem, right? Within the data center, there's the cooling equipment, there's the backup power, there's the services companies, there's the chips that go in the data centers and the power. It's the generation, it's the transmission, it's the distribution, it's the equipment, it's the services, it's the technology. I mean, there's a lot of second, third derivative opportunities that when you see these themes and you can see other opportunities that come through it. And it's equity and it's on the debt side. And that's, again, why it's so exciting. These are big ecosystems, big opportunities. A lot of disruption as well you got to stay ahead of with companies that, are on the other side of that change, but real opportunity.
I mean, but that's why hard assets are so attractive, right? When there's just so much uncertainty, this is something that's like in the ground that
For sure.
where the need is really acute. Okay, so I'll keep going with you, Ken, a little bit. Ken was formerly co-head of our real estate group and has spent a whole career as a real estate investor. So I would love you to just give us a couple minutes on where we're at in terms of the real estate recovery, which we all know is coming, but or is here.
It's here, yeah.
It's here.
My dad was a third-generation home builder, so I grew up in real estate my whole life. And I'm a big believer in real estate. It's a great part of a portfolio, but it is a cyclical business. And post-COVID, when interest rates were taken up quite sharply, real estate went through a tough few years, adjusting to that and adjusting to some supply that was delivered and this whole office. Today, when you look, real estate is clearly in our minds, my mind, in recovery phase. You can look also at the public REITs. The public REITs having a good first half of the year. They strongest outperformance versus the S&P in 16 years. We mentioned this in the piece as well. So we're seeing that positive recovery take hold. Supply has come way down. Logistics, our biggest theme. The logistics new starts are down at I think a decade plus low, so that's quite positive. Capital markets better, more lending and spreads coming in, so more available capital and more affordable capital on that side. And the demand has held up, so good fundamentals. Again, where you invest again matters, so it depends where you are and what sectors you're in. But logistics, we saw record leasing in our U.S. portfolio in the fourth quarter. We saw again strong leasing in the first quarter here in the U.S. Data centers, obviously a bigger and bigger piece of our real estate business, very strong. Grocery-anchored shopping centers, strong. The hotel business, luxury had been strong, but even now more broadly in the hotel space.
Nice to see it all coming back, yeah.
So yes, to me, real estate is a place that you want to be invested in. You particularly want to be investing in these recovery phases, and you can feel that
getting the vintage right,
stronger.
Really important.
For sure.
Yeah. Okay, so quickly, another buzzy topic is credit, right? So still seems to be
busy for you.
Oh my goodness, it seems to be dominating headlines still. What's your take? Help us unpack really what's happening on the ground versus some of the noise.
Yeah, it's funny. I think when Ken and I talk to investors, whether they're institutional or wealth channel investors, they're kind of actually on the same page with us. Like, they still get the benefits of private credit where it sits in the capital structure, a lot of equity, big deals, own the docks.
Value,
You mentioned vintage. I think they understand that when you have some dislocation, that some of the best vintages are born out of that. I really think, to go back to your job in the noise, it's really more the media conflating some sectoral disruption with some sort of systemic credit crisis. Everything that we see on the macro side doesn't point to that. So we're still constructive. If you were to ask us, and we talk about it in the paper, specific opportunity, now going back to hard assets, asset-based finance, super interesting, right? It's like a $30 trillion market that's something like 90% controlled by banks. So there's a ton of white space for our teams to lean in, do these great deals, right, backed by tangible collateral with great documentation and capture somewhere on order of a 250 basis point spread premium.
Wow.
And that goes back to that whole CapEx spend, right? Whether it's equity or in the credit markets and private equity or real estate or infrastructure capital or private credit capital, that's a huge opportunity.
That's great.
Definitely.
Yeah. Okay, should we go to the little audience question section now?
Sure, let's do it.
So a lot coming in. We'll go to one here. What themes are you monitoring that weren't discussed? Who wants to take that?
Yeah,
You
well,
can go first.
Read the paper, right? So we touch on a few of these in the piece.
I think we want what's not.
No, we touch on a few of these in the piece, but what we didn't discuss, life science is a super exciting area as well, where, again, a lot of CapEx needs. We can be a real solution provider. We have a great life sciences business. With the growth in private markets, the secondaries business is an area that we're spending more and more time. Frankly, hedge funds, another area that is getting more and more exciting and interesting.
Now you're talking.
The 60-40, I know Winfield loves talking hedge funds.
Don't get started.
With 60-40 portfolios not
Right.
working really, the hedge fund areas, and we've got a great business here that's been proving that out. So there are a lot of other, we love franchise businesses, Jersey Mike's and others that we learned from Hilton. And to me, that's why it's such an exciting time to be an investor. Yes, there's a lot of change, a lot of uncertainty, a lot of volatility in the markets, but there's also a ton of opportunity that brings up. And to me, where we're sitting and we get to see all this data, and you get to see where things are actually moving quite more strongly than people would think. And there are a lot of areas to invest today.
Okay, well, let's go to the next question. Given the current environment, what asset classes are experiencing the biggest tailwinds? Infrastructure, private equity, or real estate?
I mean, I can start, and I'll create some space for myself by saying 4 boys, so you don't get to pick your favorite kid. So I'm not going to pick my favorite one, but I'll pick one because we actually skipped over it. And my favorite one is just infrastructure writ large. I mean, to me, the mic drop, and it's in the piece, the mic drop point, the mic drop chart is McKinsey saying over $100 trillion of critical infrastructure that needs to be invested over the next 15 years. Usually infrastructure, if you go back 50 years, it was driven by the public sector, but their coffers are getting a little thinner. So it's going to be private capital that needs to step in. And so the little bitty circle in this chart, which is private infrastructure AUM, is less than $2 trillion. So $2 trillion into over $100 trillion opportunity, to me, that's really exciting.
Yeah.
Interesting. Well, so maybe we'll go to a few rapid fire before we wrap up. You ready for it? Okay, so I think I know what you're going to say to this, but one word, optimistic or cautious?
Optimistic.
Optimistic.
Okay, all right. I just want to make sure everyone was listening. Okay, so most important word for the second half of the year, inflation, AI, rates, or geopolitics?
This is going to shock Ken, that I'm going to say this, not rates all the macro stuff that I love, but it is actually AI.
Yeah, I would agree with that.
All right.
That is a
Very-
big-
a lot of,
we do
lot
say
of
that's the main
consensus
thing.
here. Biggest surprise of the year?
So for me, I'm going to go sports. For me, it's the Knicks winning the NBA championship.
Let's jump to another one for you.
Okay.
How about your beach read for the summer?
I'm going to go with a book that was recommended by a colleague called The Art of Learning.
Sounds really good. Okay, favorite podcast, and we're gonna wrap it up.
Christine, you know, I'm a history buff, an analog guy, read real books. I don't spend a lot of time on podcasts, but if you're going to make me answer
Yeah.
on a podcast, you know, we've started working on this thing here at Blackstone.
Oh, you're going there.
and I heard that that's going to be pretty darn good.
Okay, well, he just broke a little news that we are, in fact, launching a podcast. You're gonna get in trouble for that later this year in September, so stay tuned for that. But thank you both. The takeaway, I think, today is pretty straightforward. We've got a lot of consensus here on what's happening. World might be a little noisy, but the themes are pretty clear. AI, power, data centers, real assets, and flexible private capital. These are all shaping the next phase of the cycle. So thank you both very much for a phenomenal conversation. To learn more, visit the link in the description to read our mid-year investment perspectives.